Hello friends, welcome to learning sessions and good morning to all of you. And today in this video, we are going to cover the rest of the part from the foreign exchange arithmetics. That is chapter number 23 of the module C. So I hope that you must have gone through the previous video. We covered the very important topic, all the basics related to the foreign exchange arithmetics. And I suggest you that you should be going for that particular video before going for this video, because only if your basics are clear, you can be able to grasp the content from this video. And we'll try to cover up the complete chapter today, and we'll be starting with the next chapter also. So do confirm the audio video quality at the earliest first of all, so that we can proceed. So the audio video quality is working all fine. So let's start the session. We covered the numerical yesterday, and also today we are going to start with the numerical first of all. Here is the first question for today. It says that the USD is available in Delhi at 1 USD is equal to 76.10 INR. USD rate in London is basically USD is equal to 1.10 euro. What will be the euro to the rupee rate? Simple question. Simple question that we need to calculate the euro to rupee rate, and we are provided with 1 USD is equivalent to 76.10 INR. And on other scenario, we are basically given that 1 USD is equal to 1.10 euro. Now, just we need to equate these two sides. That is 76.10 INR is equal to 1.10 euro. And we were to calculate the euro to INR rate. So, euro divided by INR on one side and 76.10 divided by 1.10 on the other side. Simple as that. Okay. Now simply solving it, 76.1 divided by 1.1, that is 69.18. So the price is 69.18 we calculated. Right. So it was a simple case of the cross rate or chain rule mechanism where there is no direct pair calculation is available. So we calculated using the cross rates. Okay. Now let's move ahead. It's about the question based upon the TT buying rate. Now, when the TT rate is applicable, when we say the TT rate is applicable, TT rate is which it is telegraphic transfer. TT rate means we are talking about the telegraphic transfer rate. And when the TT rate is applicable, the TT rates are applicable when the value date is all same in both of the centers. The transaction settlement date and value date is all same in both the centers, then the rate is applicable is TT rate. Means when there is no gap, when there is no delay, there is no gap, then the rate which is applicable, it is a telegraphic transfer rate. And when we say the buying rate would be applicable, the buying rate will be applicable when the buying quote is given. When bank gives the buying quote, when bank gives a buying quote, we say the buying rate is applicable. We say the buying quote is applicable, buying rate is applicable. Okay. So when there is no delay and buying quote is given, we say the TT buying rate would be applicable. We simply say the TT buying rate is applicable. Now let's have a look at this question. It says bank XYZ received a money transfer of 10,000 USDs already credited to the Nostro account. Now the money transfer is received and it clearly says that the amount is already settled. Amount is already credited to the Nostro account. What amount will be paid to the customer if the spot rate is given, 1 month forward differential is given, exchange margin is given? What rate would be applicable? What particular amount is to be paid, that we get to know. Now, first of all, we need to know that why we are saying that the TT buying rate is applicable. So there are the points which are given in the question. We need to highlight those points. The first one, it says that the amount is already credited to the Nostro account. When one foreign currency is already credited in the Nostro account, it means the settlement is already there and the bank just need to apply the conversion rate and so as to credit the customer. So the settlement can be on the same day only. So there should be no delay. That's the requirement related to what rate? That the telegraphic transfer rate. or TT rates would be applicable. Now from this point, this is evident that the TT rate would be applicable. We know that. Now it will be the buying rate or selling rate. Now these 10,000 USDs belong to the customer, credited in the nostro account of the bank, but these are the 10,000 USDs which belong to the customer. So here is the scenario. A is the customer of the bank XYZ bank, right? And XYZ bank is maintaining a nostro account in the PQ of our bank, right? So here the nostro account is maintained. Here the nostro account is maintained, and further the amount for the person A is credited to this now account, that is nostro account, right? And the credit is to be given to the customer. So this amount of USD 10,000 that belongs to person A, that belongs to person A. Now let's say person A wants to sell the USDs. Person A want to does what? Person A want to sell the USDs. Now person A will be able to sell the USDs at the price at which the bank is ready to buy. Why I'm saying so? Because this is a merchant rate would be applicable. When the customer is involved, what rate would be applicable? It will be the merchant rate would be applicable. The perspective is to be looked at from the bank point of view. So the customer will be able to sell at a price at which the bank is ready to buy. So the bank will be giving the buying quote here. The bank will be giving the buying quote here. So what rate would be applicable? It will be the buying rate would be applicable. There is no delay. It is a TT rate. So we simply say it's a case of the TT buying rate. It's the case of the TT buying rate. So we are provided with the spot rate. The spot rate is given to be 76.30/45. This is the buying rate. This is the selling rate. And we have to look into the buying quote. So it is 76.30 that is to be looked into. And here they have also provided with the 1 month forward differential. Is it to be looked into? 1 month forward differential means the 1 month forward points are given. Are we to consider that? No. Why not? Because there is no delay. There is no delay. So why we have to look into the forward points or forward rate? No, we are not to go for that. Exchange margin is given. Exchange margin is given. There is a small trick related to memorizing the exchange margin, whether it is to be added or subtracted. Whenever it is related to the buying rate, whether it is a bills buying rate or the TT buying rate, we are to subtract the exchange margin. We are to subtract the exchange margin. So here also the exchange margin is 0.10%. Make sure you should be keeping one thing in mind, that if it is given in percentage or paise, sometimes it may be the case that they have simply said that the exchange margin is 0.25 paise or 0.10 paise. Now what does it indicate? It indicates you simply just need to subtract this particular amount. But when we are talking about the percentage, we are to subtract the percentage only. We have to subtract the percentage only. So it won't be, the answer won't be 76.20, but it will be 76.3 minus 0.1%. That is 76.2237. So now this would be the rate which will be applicable. And how we calculated it? Using this simple point, spot rate minus the exchange margin, right? So we simply just need to multiply it with the 10,000 that because we were to calculate at what amount is to be credited to the customer account. Here they have given that what amount will be paid to the customer. So it is multiplied by 10,000. So it is 762237. That is 7,62,237. This amount will be credited to the customer's account. This amount will be credited to the customer's account. Okay. Further, now let's move toward the next question. It says that 1 USD is equal to 76.1030. 2 month forward rate is given. And if person A is to remit the money after 2 months, what will be the cost to A? Now here, the person A is to remit the money, means what rate would be applicable? Merchant rate or interbank market rate? Do confirm at the earliest. What rate would be applicable? It will be the merchant rate or the interbank market rate. Now, when the customer is involved, it will be the merchant rate which will be applicable. It is a merchant rate which is applicable, right? So person A want to remit the 10,000 USD. Now, if you want to remit 10,000 USD, you should be having 10,000 USD first of all, right? So for that case, person A wants to buy the USD. Person A want to buy the USD, but now the merchant rate is applicable. The perspective is to be taken from the bank end. So person A will be able to buy the USDs at the price at which the bank is ready to sell. So the bank will be giving what quote? The bank will be giving selling quote. And when the bank is giving the selling quote, the selling rate would be applicable. This will be prevailing. The selling rate will be applicable. And also customer wants to remit the money after 2 months of the period, not today. It's after 2 months. So we are to go for the forward rate. So the spot rate is given. 1 USD is equal to 76.10/30. So this is a buying rate. This is a selling rate. We have to go for the selling quote. So this price is to be looked into. So 1 USD is equal to 76.30 INR. This is a price we have to look into. And further, the forward points. The forward points are given to be 45/35. These are the buying forward points. These are the selling forward points. Just do answer that if the currency is available at premium or discount. Just do answer if the currency is available at premium or discount. Now, how you'll be looking into it? That the currency is available at premium or discount. Now, the selling forward points are lesser than that of the buying forward points. Means the currency is available at discount. The currency is available at discount. Okay. So the selling forward points are lesser than that of the buying forward points. So the currency is available at discount. So the forward points are to be subtracted. Which forward points? The selling forward points are to be subtracted. So it is 76.30 and minus 0.35. So that will be 75.95. 75.95. Now this amount would be applicable. This amount would be applicable. This will be the cost to person A, right? So we just first of all looked into that what rate would be applicable, merchant rate or the interbank rate. Then we looked into what cost will be applicable. Now, when you have to remit the money, you should be having the money. First of all, that's the point. And you should be having the USD. So if you're having the USD, you have to buy. If you're not having the USD, you have to buy the USD. And you'll be able to buy the USD at a price at which the bank is ready to sell the USDs. So the selling quote will be given by the bank. Selling quote will be given by the bank. And when you know that the selling quote will be given by the bank, the selling price would be applicable. The selling price would be applicable. So we just selected the selling price, that is 76.30, right? And the forward points are given. The forward points are given like 45/35. We picked the selling forward points and we subtracted because the currency was available at discount, right? Now let's move ahead. It's related to the next question, which is the problem on bills buying rate. Now, on 26th of March 2020, your customer has presented to you their bill for 50,000 USDs drawn on party in USA. Request you to purchase the bill. Request you to purchase the bill. Spot rate is given, 1 month forward is given, transit period is 20 days, exchange margin is 0.15%, transit period to be rounded off to the higher month. It is to be rounded off to the higher month. Now we need to understand the problem. So what actually happened here, that we are having the client who is supposed to be an exporter. Why exporter I'm saying? Because he want you to purchase the bill. So bill will be drawn by the exporter and it will be drawn on the importer. It will be drawn on the importer, and once accepted, it will come back to the exporter, and exporter is now having this 50,000 USDs bill. The exporter is having the 50,000 USD bill with it. and it went to bank and said that you should be negotiating this particular bill. Actually, the terms are different. The terms are different, right? Like if we are talking about a demand bill, when we talk about a demand bill means that whenever the bill will be presented, the payment is to be made. That's a demand bill. Then we say it is to be purchased. Then we say it is to be purchased. And when we are having the usage bill, let's say when a clear credit period is mentioned or a due date is mentioned, then we say it to be usage bill. Then we use the term discounting, right? We say it to be discounting. And when we use the bill under the letter of credit, we use the term negotiating. So as to negotiate the bill, right? So these are the three different terms. Demand bill is purchased, usage bill is discounted, and the letter of credit under the letter of credit, the bill is negotiated. So this is a case related to what they have told us clearly in the question. The customer is asking to purchase the bill. Customer is asking to purchase the bill. Means we are talking about what bill? We are talking about the demand bill here, right? There is no difference as such when we are solving the question, but you should be knowing why we are using the term purchase, discounting, and negotiating. Okay. And the transit period is given to be 20 days. Transit period is given to be 20 days. Means it will take at least 20 days that the bank, when the bank will be purchasing the bill, we know now it's purchasing of bill. That's a demand bill, right? And when the bank will purchasing the bill, bank will be forwarding the documents through its correspondent bank to the importer and will be getting the response. They say it's a time period of 20 days. It's going to take at least, right? So that's a transit period. So definitely there is a delay. The transaction is not going to be settled on the same day. Okay. So what rate would be applicable? It's the bills rate that will be applicable. So from here we know that the bills rate would be applied, not the telegraphic transfer rate. Why the bills rate? Because there is a delay. What delay? Even if 1 day delay is there, the bills rate would be applicable because it's not on the same day. Only if it is on the same day, we say the telegraphic transfer rate would be applicable. Otherwise, the bills rate would be applicable. Otherwise, the bills rate would be applicable. But we don't know right now if it's a buying court or the selling court. Now, what actually happened at this 50,000 belongs to this exporter. And exporter want to sell these 50,000 USDs. Exporter want to sell this 50,000 USD so as to get the money in INR. And it's a merchant rate that would be applicable because customer is involved. And we have to look at the bank's perspective. Now, exporter will be able to sell at a price of 50,000 USDs, sell 50,000 USDs at a price at which the bank is ready to buy. So the bank will be giving the buying rate. So what quote will be given by the bank? It will be the buying quote which will be given by the bank. Buying quote which will be given by the bank. So what rate would be applicable? It will be the bills buying rate. Bills buying rate that will be applicable. Clear? Bills buying rate that will be applicable. And what would be the calculation? Calculation is very much easier. In case of the bills buying rate, when the delay is there, we have first of all to calculate the forward rate. We have to calculate the forward rate. And I told you that the exchange margin is always subtracted in case of the buying rate. So exchange margin is to be subtracted. This is about the formula of it. And how we can be calculating the forward rate? Spot rate plus minus premium or discount. So here we are provided with the spot rate. It is given to be, the spot rate is given to be 72.30/40, and transit period is given to be 20 days. Okay, we are not provided the forward points for 20 days. It is said that transit period is to be rounded off to the next higher month. So now we have to consider the forward points of 1 month. And these are given to be the forward points for 1 month, 0.40/50. These are the forward points given to you. What is the trend? Premium or discount? The currency will be available at premium or discount. See, these are the buying forward points and selling forward points. Selling forward points are greater than that of the buying forward points. Means the currency is available at premium. It is available at premium. So it is 72 point. What cost was to be looked into? It was a buying cost. So it is 72.30 plus the buying forward points 0.40. So rate that will be applied, that is 72.70. Is it the final rate? No, because we are to subtract the exchange margin also. It's a buying rate. So the exchange margin is also to be subtracted, which is of 0.15%. So 0.15% exchange margin is to be subtracted. So it is 72.7 minus 0.15%. So it is 72.59095. 72.59095 it is. Okay. So we have to again multiply it with 50,000, that this much amount will be credited to the customer account. So into 50,000, so it is 3629,547. This amount will be credited to the customer account, right? I hope that you must have understood the complete question here. Let me just reiterate the idea to you. So we were clearly given in the question that customer has presented you bill, means we are to purchase this bill. When we are to purchase with this bill, means we are to purchase the foreign currency. When we are to purchase the foreign currency, the bank will be applying the buying cost at which the bank is ready to buy. At which the bank is ready to buy. So the buying cost would be applicable. First thing that we know now. And there is a delay of 20 days because transit period is 20 days. So we know that the bill's buying rate would be applicable. Bill's buying rate would be applicable. And what is the formula? This is forward rate minus the exchange margin. Forward rate, we know how to calculate. Spot rate plus minus forward points. Now we know the selling points are greater than the buying points. We know the currency is available at premium. And when the currency is available at premium, we just added the forward points to it. So we calculated it to be 72.70 and adjusted the exchange margin because it's a buying rate. So the exchange margin is to be subtracted. And we got the final answer as 72.5905. Right? So if you know the basics, you can be calculating it very much easily. You can be solving it very much easily, right? So very easy to calculate. Now let's move toward the next question. It's on the TT selling rate. The problem is based on the TT selling rate. Now what rate would be applicable? Let's have a look at it. So the question says an importer has requested you to issue a demand draft on USA for 50,000 USDs. Spot rate is given, exchange margin is given. How much amount is required to be paid by the importer? How much amount is to be paid by the importer? Now let's have a look at the case here. Now the the importer has requested you to issue demand draft. To issue demand draft. Now you will be able to issue the demand draft when you'll be having the money with you. Like the same case when we were to remit the money. The same case when we were to remit the money. Now it's an instant process. Just your account will be debited. You will be given the USDs and that's it. And the amount will be issued as a demand draft or it will be remitted. So what rate would be applicable? There is no delay. There is no delay. So here is a scenario. Person A is here and here we are having XYZ bank over here and it's having a nostro account in the foreign currency in some other bank. Now what will be happening? Bank will be debiting customer A's account, right, and will be issuing the foreign currency to it and further will be issuing the demand draft to it. That's it. That's the process to be followed. Now in this process you want to buy, the customer wants to buy the foreign currency. Now it's the customer perspective, means the merchant rate would be applicable, right? So merchant rate, the customer will be able to buy the foreign currency at which the bank is ready to sell. So the bank will be giving the selling cost. So the bank will be giving what cost? The bank will be giving the selling cost, right? Now bank is giving the selling cost. We know the selling rate is applicable. Now there is delay. Is there any delay in this particular transaction? No, there is no delay in the transaction. So we now know that it's a TT selling rate that will be applicable. TT selling rate. And whenever we are talking about the TT rates, no forward points are to be looked into. Okay, so formula is very much easy. That's the spot rate and the exchange margin is to be added up, because for buying the exchange margin is to be subtracted and for selling rates the exchange margin is to be added. That's it. So the rate it is given 72.32/48. It's a selling rate we have to look into. So it is 76.48 and the exchange margin is 0.15%, that is to be added up. 76.48 plus 0.15%, that is 76.59472. That is the rate that will be applied. And how much amount is required to be paid by the customer? Multiplied by 50,000. So 38 lakh 29,000 multiplying it with 50,000 basically gives us 38 lakh 29,736. This amount is payable by the customer. Clear with it? Do confirm at the earliest that if you have understood the logic related to it. Now let's move ahead toward the next question. It's related to the bills selling rate. On 26 March 2020, importer has received an import bill for USD 50,000. He asks for the retirement of the bill. He asks for the retirement of the bill. The spot rate is given, 1 month forward rate is given, exchange margin on the TT selling rate is given, exchange margin on the bill selling rate is given, and we are to calculate it. Now, what is retirement of bill? Here we are having the exporter. Exporter drew a bill on the importer. Importer accepted the bill and give it back to the exporter. Let's say it was a usage bill. We are considering it was a usage bill, right? And for the credit period was, let's suppose it was of 6 months, right? But the importer arranged the payment just after the 2 month period and it asked for making a payment. So importer connected with its bank, let's say XYZ bank, and said that I want to make the payment to the exporter. This process is said to be the retirement of the bill. So when the export bill is to be paid off before the due date, when the export bill is to be paid off before the due date by the importer, we say it to be the retirement of the bill. Okay. Now in this scenario, the importer will be doing what? First of all, the first transaction would be related to buying the forex, because the importer is to make the payment in forex. So the first transaction will be related to, that will be done by the importer. That's buying the forex. After that, the importer will be asking so as to settle the accounts. Now, account settlement is not to be done on the same day, because the importer's bank is going to connect with the exporter's bank. Let's say ABC bank is here, and through that they are going to basically settle the accounts and get the confirmation. So that is to be done. So the second transaction would be related to the settlement of the account. Settlement of the account. So in this case, in case of the bills selling rate, two transactions are included. One, it is related to buying the forex. Would there be any delay in buying the forex? Like simply the case was there when you to buy the forex for the remittance purposes, so as to issue or so as to issue the demand draft purposes. Was there any delay in that case? No, there was no delay. So in the first case, there is no delay. No delay. So what rate would be applicable? It is a TT selling rate would be applied for the first case. For this transaction leg, it will be the TT selling rate. Why? Because importer wants to buy the forex and importer will be able to buy the forex at which the bank is ready to sell. So the selling cost will be given by the bank. Selling cost will be given by the bank. So the rate would be the spot rate, and further now it's the selling rate. So what will be done? The exchange margin will be added or subtracted. The TT selling exchange margin will be added up. And the second leg it's related to what? The second leg it's related to exchange of the account. Now after this particular transaction is done, the exchange margin for the bill selling rate, bills selling exchange margin, that will also be added up. So this is the transaction, whole transaction here. Clear with it? So the first case is spot rate is given, 114 point is given. That is not basically, that won't be used. This is just the data given to you for the so as to make you so as to confuse you. So it's a buying rate and the selling rate. We have to look into selling rate because customer wants to buy, the selling cost will be given. So it will be 72.40. This is a spot rate that will be applicable, and exchange margin of TT selling rate is 0.15%. So it is to be added up because it's a selling rate. So in case of selling rate, exchange margin is added up. So it is 72.40 plus 0.15%. That is 72.5086. This is the price at which the USDs are sold to the customer. Sold to the customer by the bank. Right? And further, we have to add the exchange margin for settling of the account to, that is 0.20%. Plus 0.2%, that is 72.6536. 72.6536. This price would be available. This price would be available. Clear with it? Kindly do confirm. Right? So this would be the answer. So this price would be finally be applicable. And if they have asked you that what amount is payable by the customer, so it will be multiplied by 50,000. So that was it. I hope that you must have understood the complete chapter so far. So if you have understood the complete chapter, make sure to like this video, and also if you want to get the PDF of this file, just simply WhatsApp JAIIB to the number 83609 or you can simply be downloading our application from the above link, that is iibf.info/app. From the link above, that is iibf.info/app. Simply just download the application, and if you are iOS user, use the org code GEGKT. Use the org code GEGKT. Okay, so that will be all. Now the next chapter that we're going to start is capital structure and the cost of capital. That's the chapter number 24 from the module C. Chapter number 24 from the module C. Now, what is the cost of capital, or what is capital structure first of all? What do you mean by capital structure? Now, capital structure is like from where we are getting the money so as to invest in the long-term uses, from where we are getting the money. So the first scenario it could be, let's say that's the company XYZ we are talking about. XYZ company we are talking about. So either you can be raising the money by the equity, that you will be losing your controlling stake, and further you can be raising the money from equity, or it could be the case that you can be taking a debt. Either it's a short-term debt or a long-term debt. So the composition could be either from the equity or it could be from the debt, right? So that is the capital structure. So that is a capital structure we are talking about. So we are having the two types of funds only. One it's related to the equity, that is the owners funds, and the other one it is a debt over here. And capital structure is a combination of both debt and equity. It's a combination of both, that is debt and equity, used by the company so as to finance its overall operations and the growth. Okay. Now, in case of the equity, the company is to pay the cost. What cost is to be paid? The dividend is to be paid off. In case of the equity, the dividend amount is to be paid off to the equity owners, to the shareholders, if the profit is there. And in case of the debt, let's say if you have taken a debt, the interest is to be serviced. We need to service the interest amount. In case of bonds and debentures, we were to pay off the coupon. In case of the loan, we are to pay the interest. So that is to be done. Okay. So capital structure is nothing, but it's a combination of the debt and equity that we know now. So let's have a look at this particular thing. So firm started its business raising total term funds of 500 lakhs. Total term funds of 500 lakhs. So as to meet its requirement, the equity capital is 200 lakhs. The debt capital is 300 lakhs. Total fund is 500 lakh. Now, what is the capital structure? It is equity is 200 divided by 500. We will be calculating the percentage of it, and it comes out to be 40% of the equity capital. And for the 300 divided by 500, that is 60%. That's basically the debt capital. Okay. And what do you mean by leverage? Leverage means you're not using your own funds, but you are using the borrowed funds more. When your capital structure is carrying more debt part, we say it to be leveraged. We say it to be highly leveraged, right? So if the ratio of the debt capital is higher, we say it to be highly leveraged or highly geared firm, right? So it is more riskier or lesser riskier? Yes, it is more riskier. More is the leverage, more is the risk associated with it. And low leverage means when the equity component is more, but the debt component is lesser, then we say it to be low leveraged. Then we say it to be low leveraged or low geared form. And what are the different factors which are going to influence the decision of capital structure, that you should be borrowing more or you should be using your own funds more? The first one, it's related to norms prevailing in the financial market. Norms prevailing in the financial markets. Like each and every country is going to have their own lending policies. Each and every country is going to have their own lending policies, their own norms based on the long-term experience. Now, that's basically the rule of land, we can say. Okay. Now, if the terms and conditions are very much lighter, then definitely the companies will be borrowing more, otherwise not. And second, also it's a company's own judgment, like if they want to have the more degree of control or not. Because if you're raising the money through the equity, you'll be losing your control. You'll be losing your controlling stake, right? So you're going to dilute the voting rights for you if you're going to issue more capital by the way of equity. So that's also to be looked into. Further, if the cost of debt is higher, then definitely you'll be preferring the equity. And this is the most important consideration, that's the cost of debt. Now, cost of debt also decides a lot for the firm, cost for capital structure. And then the fourth one, it's related to size of the firm and its business plans. Now, if the company is having some future plans for which it requires a very huge fund, right? And further, company may be deciding upon that what's its intention for the future expansion, right? And also it may be the case that it may not be able to keep up with the high equity capital base and maybe preferring the higher proportion of the debt, because debt is easier to be repaid rather than the equity. Equity cannot be repaid easier, right? So that's the case. So that's the case. And we are having the multiple approaches on the capital structuring. We are having the multiple approaches on the capital structuring. The first one, it's the net income approach that was given by the David Durant. That was given by the David Durant, and we say it to be the net income approach. What approach? Net income approach. Okay, and it was propounded by the David Durant. So they said that the capital structure is relevant. Capital structure is relevant, and if you are to increase the debt in the capital structure, that we know that capital structure is either the debt or it's the equity. So they said, as per the David Durant net income approach, they said if we are going to increase the debt component in the equity structure, debt component in the capital structure, that's going to reduce the overall WACC. WACC is weighted average cost of capital. Means a average cost including the debt and the equity. So if you are having the composition, let's say 60% related to the debt or 40% related to equity, and on the other hand we are having 40% of the debt and 60% of the equity, as per the David Durant net income approach, they said more is the composition of the debt, lesser will be the overall cost. Lesser will be the overall cost, that's it. So they basically assumed that the cost of debt and cost of equity remains the same. Cost of debt and cost of equity remains the same, irrespective of whatsoever the proportion of is there in case of debt and equity. And as the cost of the debt is lower than that of the cost of the equity, the cost of debt is lower than that of the cost of equity, the overall cost, that is WACC, that is a weighted average cost of capital, that can be decreased if you will be having the higher proportion of the debt. If you're having the higher proportion of that debt. Okay. So we'll be making company more geared. We'll be doing what? We'll be making company more geared, more leveraged, and at the same time, we are going to reduce the WACC, right? And what is WACC? It is cost of debt multiplied by proportion of debt plus cost of equity plus proportion of equity. So that's the net income approach by the David Durant. By the David Durant. So here is a question. It says that ABC Limited has a capital structure comprising of 50% of debt and 50% of equity. The cost of debt is 10%, the cost of equity is 16%. Its WACC would be equal to what? Cost of debt is 10%, so it is 10, multiplied by proportion of debt is 50%, so it is 0.5, plus cost of equity is 16, so it will be used as it is, and for the proportion of equity is 50%, so 0.5. So this would be your WACC. So we can simply be calculating the WACC here, right? And that will be it. And that would be it. And we calculate it to be 13%. Weighted average cost of capital. We calculate it in percentages. That's why we kept the cost in the same number. We never changed it to the decimal part, right? Make sure that you should be knowing that whenever we are calculating the WACC, the cost of capital or cost of equity, debt or capital, debt or equity should be in the percentage used as it is, whereas the proportion is to be converted to a decimal component. Okay. Now, what if the proportion is changed? What if the capital structure is changed? 60% is the debt now and 40% is equity now. Now, if the debt is 60%, that's the percentage of the debt was increased from 50% to 60%, and the proportion of the equity decreased from 50 to 40%. Now the WACC we calculated to be 12.4%. It is now reduced. This is the net income approach by the David Durant. This is a net income approach by the David Durant. The next one, it's related to net operating income approach. Net operating income approach. Now the NOI approach or the net operating income approach is basically assumes that the WACC is going to be remain unaffected. Now in the first case, that's the first case was net income approach. In that case, we basically assume that the cost of debt and cost of equity is going to remain all same, right? But under the net operating income approach, we assume that the WACC, that is a weighted average cost of capital or the value of the firm, remains unaffected by the change of the debt proportion or the capital structure. Now, whatsoever the proportion of the debt or the capital structure is there, debt proportion of the debt or proportion of equity is there, it is not going to be impact the WACC. WACC is not going to be changed. And as per this particular approach, the market value is dependent upon the operating income. Market value is dependent upon the operating income here. Clear? So it is dependent upon the operating income and further and depends upon the business risks. So whatsoever the market value is there, it's going to depend upon the operating income. It's going to depend upon the business risks. That's it. Okay. And further, both of these factors are not impacted by the financial leverage. Both of these factors are not impacted by the financial leverage. Means whatsoever the proportion of the debt or equity is there, it's not going to impact the WACC. WACC, that is a weighted average cost of capital, is not going to be impacted by the same. And further, the market value is dependent upon what? It is dependent upon the operating income and the business risks. So let's have a look at this particular question. It says that ABC Limited capital structure is comprising of 50% debt and 50% equity. The cost of debt is 10%. Weighted average cost of capital is 13%. The NOI approach assumes that the WCC remains constant irrespective of the debt equity proportion. For given proportion of 50-50, the cost of equity will be what? Now, what will be the cost of equity in that scenario? Now, we know the formula that is available with us. WCC is equal to what? Weighted average cost of capital is cost of debt into proportion of debt. Cost of debt is given to be what? Now in this case, the cost of debt, it is given to be 10. So it will be used as it is. And what is the proportion? It is 50-50. So it is 0.5. And further plus cost of equity. Cost of equity we don't know. We don't know the cost of equity that we need to calculate. Cost of equity we need to calculate. Okay. And further, what is the proportion of equity? It is 50%, that is 0.5. And you are provided with the WCC also. WACC, it is given to be 13%. Right? We can be solving it then. So it will be 13 minus 5, that is 8 divided by 0.5. So we can easily be solving it. So it is 16%. So cost of equity came out to be 16%. Okay. So we can easily be solving it. After that, it says that if the capital structure is changed, that now the capital structure is 60% debt proportion, 40% equity proportion. Now WCC will remain all the same because as per the net operating income approach, the WCC is going to be all same. It's not going to change with the composition of the debt or equity. Now the cost of equity will change to 17.5%. Now cost of equity will change. In the case of net operating income approach, what happens? That the WCC remain constant, and in under the net income approach, the cost of debt and cost of equity remains same, irrespective of the proportion of the debt or equity. Clear with it? Now, after that, it's about the traditional position approach. It's about the traditional position approach. If you have understood the topic so far, please do confirm at the earliest. The next one, it's the traditional approach, or we can say intermediate approach. Now we do know actually the capital structure is relevant and there is a optimal capital structure where we will be having the WACC, that is weighted average cost of capital, as minimum one, where we are having the minimum WACC, and we also said the firm valuation is maximum. So that will be an optimum solution for it. We want to maximize this thing and we want to minimize the WACC. So we are going to take a middle position of the NI approach, net income approach, and the net operating income approach. So the middle intermediate version of net income approach and the net operating income approach by the David Durant, that we need to take care of it. So what's going to happen? Moderate, if you're going to use a debt moderately, if you're going to use a debt moderately, it is initially going to reduce the WACC. So moderately, when you are using the debt, moderate usage of debt, right? That's going to initially reduce the WACC. WACC is going to be reduced and further the firm value will increase. But when you will be having the excessive debt, the financial risk will increase, the cost of equity will increase, and the WACC will increase. So the WACC is going to use the U-shaped curve. It's a U-shaped curve which will be there related to the WACC. Now let's have a look at the theory part over here. So as per the traditional position approach, when the proportion of the debt capital is going to increase in the capital structure, the cost of debt will start increasing, right? It will, first of all, the cost will basically be decreasing, but after some particular point, the cost of the debt will start increasing after some certain point. Because when the more debt will be there, now the creditors will be worrying more because more risk is associated with the leverage, right? So that's the case. So the cost of equity capital will also going to increase with the increasing leverage. The cost of equity capital will also increase when the leverage will increase. It will remain constant up to some point, but gradually it's going to increase. Means when you're using lesser debt, then your weighted average cost of capital will decrease. But when you are increasing your debt component, after some certain point, overall risk will increase, and further the WCC will increase, and further the cost of equity will also increase because the equity holders will also be more worried about it because you are using more leverage. And ultimately, the cost of equity will also be increasing with the increasing leverage. It will remain constant up to some certain point, but after the certain level of the leverage, the cost of equity will also be increasing and that will be showing a sharp turn. That's why we use the term U-shaped graph for the WCC. Clear with it? So that's the point related to it. I hope that you must have understood the points so far. So that will be all related to this video. I hope that you must have understood the points related to it, and the rest part will be covering the next video for this particular chapter. Make sure to like this video and share this video, and do WhatsApp JIB to the number 83609 if you want to get the PDF of this particular session. And all the PDFs, all the videos, all the previous questions, mock test, mega test are available on our application. You can be enrolling into the JIB early bird pack where each and every detail is available. And make sure to like this video and share this video again. And if you have not subscribed, make sure to subscribe the channel also. Thank you so much and see you again.